Michael, usually I turn to Michael Santoli right now and ask him what stood out amid the sort of flattish action on the averages. He's not here, so I'll turn to you. Michael Yoshikami, what'd you see?
What's interesting is that you actually had a stability in the market despite all the uncertainty that's floating around right now. Obviously, oil prices have rallied rather significantly, and staples, as you mentioned, have really had an amazing year as people are less concerned about interest rate increases and maybe more concerned about stability going into 2019. So I think all in all, a pretty solid session, and I think really suggests that the market is well positioned to at least hold its gains, if not move forward.
Kevin, your own take in terms of the market flattening off a little bit, but so close to highs. Where do you want to be positioned at the moment?
I haven't found anything that's really compelling to buy outside of equities yet, because fixed income's still not that attractive. Too much duration risk. So I think what's going to happen is we're right in the height of earnings season. We're going to be pretty happy with earnings. I don't think it's going to be anywhere near as bad as we forecasted back in Q4. There's some pressure on margins. Everybody knows that. That's built into market pricing. And then there's the specter, which is intriguing, of a trade deal with China, unknown the timing, but the next leg up to me is around that trade deal. I think it'd be very compelling to be long equities, particularly large cap S&P companies that do business in Asia, to go into that trade deal and then stay long for another 4 or 5 quarters. So I think that's what's keeping the market quite low in volatility and a lot of optimism, because we're not getting disappointed by earnings.
Michael, as far as earnings, I hear two things. One, the bar has been set so low, so there's a lot of actually room for companies to come out with good news. But then I also hear that companies always beat earnings expectations on the bottom line. So how do we judge the quality of what we're getting from the company side and whether it matches these kind of valuations and higher valuations potentially for stocks?
Well, that's a great question. You're absolutely right. Companies are managing earnings so they can at least meet or beat. So that's why stocks get punished so much when they miss, is because the companies know exactly what they need to do to be successful. What I think you want to look at is a couple things. First of all, you want to look at gross revenues. What is the business doing itself? Margins, a lot of times, if that doesn't have to do with input costs, like commodity costs, has to do with how successfully they're operating as a business. You want to look at gross revenues, gross sales. And then secondly, I think you do want to look very, very carefully at where they're deriving a significant percentage of their revenue. As Kevin just mentioned, I think a big overhang and possibly a positive for the market is what's happening in China. I'm in China fairly consistently, and I think that China is a little more gloomy than we think here in the United States, so we'll have to see how that plays out. But those are the two things I look for when I'm really assessing the quality of earnings on a quarterly basis.